Welcome to this presentation on the balance sheet. Today, we'll explore one of the most fundamental financial statements that provides a clear snapshot of a company's financial position at any given moment in time. By the end of this video, you'll understand several key concepts. First, what information is reported on the balance sheet and how that information is structured. Second, how to measure a firm's financial position at a specific point in time using the balance sheet equation. So what exactly is a balance sheet? Think of it as a financial snapshot taken at a fixed point in time. It reports what a company has and what it owes. The resources a company owns are called assets. These could be cash, equipment, buildings, or inventory. On the other side, we have liabilities, which are the obligations the company must pay, such as loans, accounts payable, or other debts, along with equity, which represents capital contributed by owners of the firm. The balance sheet follows a fundamental equation. Assets equal liabilities plus equities. This equation is the foundation of all accounting. Assets are listed on the left side of the balance sheet, while the right side shows how those resources were funded. There are two sources of financing. First, liabilities, which represent debt financing and other obligations the company owes to creditors. Second, equity, which represents capital contributed by the owners and any earnings that have been retained in the business rather than distributed to shareholders. Assets on the balance sheet are organized from most liquid to least liquid. The more liquid an asset, the higher it appears on the balance sheet. But what does this concept of liquidity mean? Liquidity has two important dimensions. First, it's a measure of how easily an asset can be converted to cash. And second, whether it can be converted at its fair value without taking a significant loss. Let's break down the asset side in more detail. Current assets are the most liquid assets a company owns. This category includes cash, which is already in its most liquid form, marketable securities that can be quickly sold, accounts receivable that will be collected soon, and inventory. It's worth noting that inventory is typically the least liquid of the current assets because it must first be sold before it becomes cash. Fixed assets, on the other hand, are less liquid. These include property, plant, and equipment that would take longer to convert to cash. The balance sheet uses a one-year cutoff rule. If an asset can be converted to cash within 1 year, it's classified as a current asset. If it takes longer than a year, it's classified as a non-current asset. Now let's look at the right side of the balance sheet, which consists of liabilities and owner's equity. These are ranked by preference in liquidation, which is a critical concept. Liabilities are positioned above owner's equity for an important reason. In the event of liquidation, creditors get paid first before owners receive anything. This positioning has significant implications for understanding the relative risk of creditors versus owners. Creditors have a safer position because they have priority in claiming the company's assets. Like assets, liabilities are also split between current and non-current categories, with current liabilities being those due within 1 year. Let's revisit the balance sheet equation. Assets equal liabilities plus equities. This equation measures the capital structure of the firm. In other words, it shows what percentage of the company's assets are financed with equity versus debt. This is crucial information for investors and creditors who want to understand how the company is funded and what level of financial risk it carries. Here's another way to think about the balance sheet equation. The difference between assets and liabilities is equity. In personal finance terms, this is referred to as your net worth, which is how we measure wealth. It represents what the owners truly have or own after all obligations are paid. If you sold all your assets and paid off all your debts, what remains is your equity or net worth. Let's make this idea more concrete with a personal finance example. Imagine you purchase a home for $100,000 and put 20% down as a down payment. You borrow the rest from a bank. How does this translate to the balance sheet equation? Your asset is the home worth $100,000, so we list that on the left side. Your liability is the mortgage of $80,000, and your equity is the $20,000 down payment you made. So we see $100,000 equals $80,000 plus $20,000, and the book value of the asset on the left balances perfectly with the funding sources on the right. Let's review the key ideas we've covered today. The balance sheet is a snapshot in time that reports a company's assets on the left side and how those assets are financed on the right side, either through equity or debt. Assets are organized from most liquid to least liquid and are divided into current and non-current categories. On the right side, liabilities are reported as current if they are due within 1 year, or as long-term liabilities, along with sources of equity capital, including capital initially contributed by the owners and later accumulated through retained earnings. The balance sheet equation, assets equal liabilities plus equity, measures the capital structure of the firm and can be used to measure the wealth or net worth of an individual, making the balance sheet a rich resource in our financial decision-making. As always, thank you for investing in your knowledge, and see you next time.